Did you know 90% of all businesses fail within 10 years? Did you know that the average economic cycle lasts 10 years? And did you know that 90% of all business owners don't know how to read or don't read their financial statements of their business? Well, those are three random statistics I found, but I think they're all connected. Hello, my name is Mark Helm. I'm the author of Creating Wealth Through Self-Storage, and I'm the creator of the Self-Storage Quick Start Academy. I support people who are getting in the self-storage business, and I support small investors who want to grow their self-storage business, do so in a strategic way that creates true wealth and a fulfilling career. And yes, 90% of all businesses fail within the first 10 years. Now, don't fool yourself. If you own self-storage or if you're getting in the self-storage business, you are a business owner. I know it's a real estate play, but it's also a business, an operating business. In many ways, we're double exposed. We're exposed in the economic cycles through real estate. We're also exposed through businesses as well. Warren Buffett says the language of business is accounting. Now, for a guy like me, that's a scary thought because I've had no training in accounting and no training in business. And believe me, those always sounded like the last things I wanted to spend my time on. But yet, if you're in the self-storage business, you're in business. And if you own a business, accounting is the language of your business. So I learned quickly, especially when using other people's money, that I had better learn the language of business because I was responsible for other people's money. Now, it doesn't matter whether you're using your money, your family's money, investors' money. If you're in the self-storage business, you're in business. If you're in business, you'd better learn the language of business. Now, much of what I'm going to share with you today I've learned through Keith Cunningham, and I highly recommend, if you want to go further into this, connecting with Keith Cunningham and his material has helped me immensely. But I want to share with you some of the basic knowledge I've learned about the language of business and how to read the financial statements that your business is going to generate. So before we get going, a few background things. One thing I've discovered is that the average life cycle of an economic life cycle is 10 years. Look, from the bottom of the top of the wave is about 10 years. Sometimes it's longer, sometimes it's shorter, but the consensus is it's approximately 10 years. So most business owners, including self-storage owners, we ride the wave up in good times and we make a lot of money. And we think we're doing well and we think we're real smart. Then something happens, it turns, and all that money we've made, we very often give it all back, and sometimes even more. Remember 2008? That was a lot of fun, wasn't it? So I have found it's extremely easy to make money. If you want to make money, here's what you do. Start a business, buy a self-storage business at the beginning of an economic cycle and ride it to the top. It's easy making money. The real skill, the real art is keeping that money when the economy turns. So the three statistics I've randomly put together are: 1, 90% of all businesses fail within 10 years. 2, the average life cycle of an economic cycle is 10 years. And 3, 90% of all business owners don't read or don't know how to read their financial statements. So let's just assume right now that all of those are connected. So what that means is there's 10% that are going to do well and live, and their companies are going to live long past one economic cycle. So let's take on being that 10% as we get in and grow our self-storage business. So to do that, I assert that what makes a difference is to be able to read your financial statements. And I don't mean just look at numbers. I mean be able to read the financial statements in such a way that the numbers tell you a story, From that story, you can take action to generate different numbers and then turn those different numbers back into another story so you can take further action. So it takes a little bit of training to do that. You're not born with that skill. And it's not a skill that I necessarily wanted to learn. But here's what I got. If you're a business owner, if you're a self-storage owner, you had better learn that. Otherwise, you're just riding the tide up and you're riding the tide down. And that's what the 90% do. Let's be part of the 10%. So first of all, I got to tell you, I am not a specialist at all in accounting and reading financial statements. I'm proud of that fact. I don't want to be a specialist. And if you are an accountant and you are a specialist and you have a lot of knowledge in this, my request is don't laugh at me as I go through this. What I had to do was to dumb it all down. I had to take the language of accounting, dumb it down till it was something that I could understand, and then from something I could understand, I could begin to make sense and create a story from the numbers I was seeing on the paper. When I listened to the accountants talk to me, it didn't make any sense. So I had to do my own research and my own work to dumb it down. I've discovered that business is a game. It's a game. And like every game, the game has its own language and its own way of keeping score. How you keep score in football is very different than how you keep score in soccer. And how you keep score in soccer is very different than how you keep score in baseball. There's no sack in baseball. There's no extra point in soccer. Each game has its own language. Now, I needed to learn the language of accounting because that's the language of business, and self-storage is a business. So what I discovered is, in the game of business, there are referees, scorekeepers. The scorekeepers are the accountants. You need to learn the language of the accountant. Money are the points. How you win the game of business is the money that that business, or the profits that that business generates. I've discovered profits and money are two separate things. We'll get into that in a little bit. But in the game of business, I've discovered there's three big scorecards. And if you can read those three big scorecards and you can connect those three big scorecards, all of a sudden, all those stupid numbers that used to show up on all these reports begin to make sense to a business owner. And from that sense, you can tell a story. And from that story, you can create what's the next action to take. In other words, dials and levers start emerging that you can turn and pull that will have an effect on the future numbers that you generate. And you're not just doing random things hoping that the business is going to improve. So what I want to do is take the next few weeks and talk about the three big scorecards that we use in business to tell us how our business is doing. So let's talk about the first scorecard. So it turns out that every business has stuff in it. It has things and it has stuff. So if you're in the self-storage business, what are some of the things and stuff of self-storage? Well, you've got your self-storage buildings. Those are things, right? You've got the fence that goes around the self-storage building. Those are things. You've got your retail items that you sell in the self-storage business. That's stuff. It's physical, hard stuff that you can see. So every business, it turns out every business has things and stuff. Look at this simple diagram of the first scorecard. So every business has things and stuff, right? What else? Well, computers are things and stuff. It also turns out that the scorekeepers call money stuff as well. So if you have $35,000 in your operating account, to the scorekeepers, that's stuff. And that goes on this scorecard right here. Here's another thing. The fact that on the first of the month or on the anniversary date, depending on how your self-storage facility is set up, your customers will owe you money. So for the scorekeepers, that owing you money is stuff as well. They call that stuff accounts receivable. The retail, all that I go on all the time about retail items in your facility. That's stuff too. That shows up on this particular scorecard. So like I've said, every game has its own language, and in the language of accountants, they have four main kinds of things and stuff. One is cash, one is accounts receivable, one is inventory, and one they call PP&E, property, plant, and equipment. So all of the things and stuff of your business, as far as the scorekeepers are concerned, they fall into one of those four items. I don't care. To me, it's all just things and stuff. So what you do is you put on the first scorecard all of the things and stuff of your business, and that takes up half of the scorecard. Then I figured out the other part of this scorecard is you or the business either owes or it owns most of the things and stuff. So what are some things that your business owes? Well, you owe your taxes, right? So each month, as your tax bill accrues, that's something you owe. That goes here on the scorecard. You owe the light bill, right? You owe the insurance bill. All that stuff you owe to run that facility, that goes here as well. Now it turns out that the scorekeepers have a word for that. They call that accounts payable. What are some other things you might owe? Well, most of us have a mortgage from a bank to buy or build the facility. That goes here. But the scorekeepers don't call that accounts payable. They call that liabilities, long-term liabilities or short-term liabilities. I guess the difference is interest. It's called long-term liabilities if there's interest involved, and if there's no interest, I guess they call it accounts payable. I don't care. It doesn't matter to me. It's all just stuff I owe. Here's where it gets a little weird. As a business owner, we also own stuff too, right? Well, it turns out that the scorekeepers say that the profit we make, we own that profit. It also turns out that the money that we invest or that our investors invest in, we own that too. So that's stuff that on this scorecard, the scorekeepers say we own that. I guess I'm glad we own our profits. I guess in other times or other places, somebody else could own your profits. But in this game, in this time, the scorekeepers say we own our profits. Now here's what gets really cool about this first scorecard. See the things and stuff side? If you add all that together, that's going to equal the other half of this scorecard, which you owe and own. So what you owe and own is going to equal your things and stuff. I think that's pretty cool. Now let's drill down a little further. With that knowledge, you can begin to tell a story about a business looking at just this first scorecard. So let's say for this company, our things and stuff equals 10. Could be 10 million, could be 10,000. We're just going to call it 10. And let's say you owe 8. Then what do you own? That's right, 2. Right now, you're already ahead of many business owners who don't know how to read the first scorecard. I think it's pretty cool that those sides balance. I guess that's why the scorekeepers call it a balance sheet. I'd rather call it scorecard 1. They call it a balance sheet. But I think that's pretty cool. Now, I like things and stuff. They call that assets. They don't call the second part of the balance sheet O. They call that liabilities. And they don't call the third part of the scorecard own. They call that equity. So there's a couple other things I want to talk about under the own side. It turns out that you own your profits. I guess that's a good thing. But there's really two kinds of profits, according to the scorekeeper. There's the profits that come in in scorecard number 2, that is not a snapshot. That's like a movie. Scorecard number 2 is over a period of time. And whatever the period of time is for scorecard number 2, that shows up on scorecard number 1 as profits. They call it net income or net revenues or whatever, but it's profits. And then it turns out that there's profits that the company's made before that movie on scorecard 2, and those profits have not been given back to the owners or the investors. It's still in the company. They call that retained earnings. I just call that profits you haven't given to the owners and profits you made during time period number 2. Now, what can you tell from scorecard number 1? Well, let's take a look at a couple companies here. Let's look at company 1. Let's say company 1, things and stuff is 10. They owe 6 and they own 4. Now let's look at company 2. Their things and stuff is 1,000. What they owe is 996, and they own 4. So here we have 2 companies that own 4. In other words, they have profits of 4. But these are 2 vastly different companies, aren't they? So look at company 1. On assets of 10, they can generate a 40% profit. Company number 2 can only generate less than 0.5% on their assets. So these companies are not alike, are they? Which one would you rather own? Which one would you rather buy? Which one would you rather invest in? Which one of the 2 companies is run better? Does company 1 run better than company 2? Or company 2 run better than company 1? Which one do you think would cost more to buy? Same profits, what would cost more to buy? Isn't that cool? From scorecard number 1 now, you can look at a company, you've looked at 2 different companies, and you can create a story from the numbers that you see now on those scorecards. How many of you could do that before we started this episode? That's what's really cool about beginning to learn the language of business and then be able to read the scorecards of business, because then a story emerges, and from the story you can begin to tell things about the company. And once you can decipher information from numbers, you can take action to generate different numbers. That's what's really cool about this. That is the intention of this series. So that is scorecard number 1. There's a lot more to it. We'll talk more about it in the upcoming episodes, but you now know more about the first scorecard than you did before this series started. You're beginning to be able to translate accountant speak into real understandable language. And when you can do that, you are empowered as a business owner. You're no longer a victim of the waves of the economic cycle. You can begin to look at the scorecards and know what to do. So next week we're going to look at scorecard number 2. This is the one that most people look at, and this is the one I was shocked at that I really didn't understand at all what I was seeing when I looked at it. So we'll talk about scorecard number 2, then the week after that, we'll talk about scorecard number 3 and how they all 3 tie together, and I found that to be pretty cool. So between now and next week, look at your scorecard number 1 and begin to tell me what you can begin to decipher about your company from scorecard number 1 if you own one. If you're looking at purchasing a facility, look at scorecard number 1, the one they call the balance sheet, and begin to tell yourself what you can learn from looking at that first scorecard. So thank you very much. My name's Mark Helm. I'm the author of Creating Wealth Through Self-Storage, and I'm the creator of the Storage World Analyzer. And the Storage World Analyzer is a fantastic tool I use literally every day to analyze self-storage projects that we're looking at, and it is a powerful tool in our briefcase of tools as we go out and get in and grow our self-storage business. You can find find out more about the Storage World Analyzer at Creating Wealth Through Self-Storage or storageworldanalyzer.com. Thank you very much, and I look forward to connecting with you again soon.